$2, 500 to $5,000 of your annual dividend income just vanished because you own the same 5 megacaps as 60% of other retail investors. And the Fed's rate repricing just accelerated the damage. Most people believe dividend-paying blue chips are uncorrelated safe havens, that owning the same 5, magnificent 7 dividend stocks as everyone else reduces risk. Here's the problem. As of Q3 2024, the top 7 stocks represent 33% of the S&P 500, nearly triple the historical 10-15% concentration level. Morningstar's analysis confirms 60% plus of retail dividend-focused portfolios hold identical top 10 positions. When rate expectations shift, these holdings don't reprice independently. They reprice together. That's not diversification. That's hidden concentration risk disguised as safety. By the end of this video, you'll understand the exact mechanism. How a $500K portfolio concentrated in 3 megacap dividend payers could lose $50K, $75K in valuation during a single 6-month repricing cycle, and why that matters before year-end rebalancing windows close. Let's start with the data most dividend investors miss. The Federal Reserve's September 2024 FOMC statement confirmed the Fed is approaching the end of its hiking cycle. That's good news for the economy, but it's triggering immediate repricing of dividend assets. Here's why. When rates rise, the present value of future dividend streams falls. A stock yielding 3% looks attractive when Treasury yields are 2%, not when they are 5%. As rate expectations shift downward, signaling the hiking is done, markets are aggressively repricing dividend stocks upward. That sounds positive. Except, if your portfolio is concentrated in the same megacaps everyone else owns, you're competing with millions of other sellers trying to exit simultaneously. Valuations compress faster. Yields spike. Annual income drops. Consider this scenario. A household with a $500K portfolio concentrated 40% plus in 3 dividend megacaps. Think, a mix of Vanguard VYM, Schwab's top holdings, or direct megacap positions, experiences what? BlackRock in FactSet data shows these concentrated portfolios underperform broadly diversified dividend strategies by 8-12% during repricing cycles. That's $40K, $60K in losses. But the income hit is worse. If dividend yield compresses 5,100 basis points across your concentrated holdings, a realistic scenario per S&P data from the last 2 rate cycles, a household earning $25, $000 annually in distributions sees that drop to $20, $000.25, That's $2, 500 $5,000 less per year for households planning to live on that income. Here's where it gets worse. This repricing is happening now. The Fed's forward guidance and market expectations are already shifting. Investors relying on dividend income face a choice: rebalance before valuations stabilize, locking in losses and triggering tax liability, or hold and hope the repricing stops. Neither option is pleasant if you didn't audit your concentration beforehand. The hidden mechanism most advisors don't discuss. When concentrated dividend portfolios lose 8-12% in a 6-month window, those losses hit during exactly the moment when interest rates are finally falling. Rising rates compress dividend valuations. Falling rates lift them. But if you sold into weakness, or were forced to by principal drawdowns, you miss the recovery. You've crystallized losses, while dividends-focused competitors with broader exposure capture the bounce. Research from the Federal Reserve's Q3 2024 survey data confirms household dependence on investment income is at 15-year highs. Over 30 million U.S. households rely on distributions for lifestyle expenses, yet 60% plus hold concentrated megacap portfolios. The audit question is simple. Do your top 10 holdings represent more than 40% of your portfolio? If yes, you're carrying hidden concentration risk. If your top 5 holdings match the top 5 in VYM, or DGRO, the 3 most popular dividend ETFs, you're holding identical positions as millions of other retail investors, meaning your valuations move in lockstep with theirs. The urgency is real. Year-end tax loss harvesting windows close December 31. Rebalancing windows for the 2025 tax year also close then. If you're planning to diversify a concentrated dividend portfolio, the time to audit is now. Not in January when repricing has already hit hard. If you want the full math and the exact portfolio audit checklist, the deep version is in my book Market Cycles Decoded. Link in the description. It walks through the exact Morningstar concentration screens and rebalancing formulas for dividend investors. The biggest takeaway: concentration in dividend stocks feels safer until the Fed pivots. Then losses accelerate. If your portfolio is concentrated in the same 5 megacaps as 60% of other retail investors, your income strategy isn't diversified, it's synchronized, and synchronized portfolios reprice together. If this opened your eyes on hidden concentration risk, hit subscribe. I'm covering the megacap reversal, where dividend flows go when rates stabilize next week. Ring the bell so you don't miss it. What's your biggest concentration risk? Drop it in the comments. Markets reward the patient and the prepared.